What's up everyone, this is Z Investor and we're back with another banger video. But before I start, I want to thank you guys for the overwhelming love and support we've been getting for the content we've been pushing out so far. It means so much to us to grow this channel, but it means so much more if you guys could like and subscribe or even just comment what you thought about this video. It really helps us push better content out. But anyways, let's move on to the video and talk about ETFs. We'll first be covering what they are, why they're useful, the difference between them and stocks, and finally, strategies that you can use to take advantage of ETFs and cash in some big money. An exchange-traded fund is a type of security that tracks a commodity, sector, or another asset, but can be purchased and sold on a stock exchange the same way you buy and sell stocks normally on a stock exchange. An ETF can be structured to track the price of an individual commodity or track the price of a large diverse collection of securities. ETFs can even be structured to track specific investment strategies, such as growth investing or value investing. As you might know, stocks are units of a company that can be bought or sold on a stock exchange. If I want to buy a share of Apple, I buy one share of Apple when I buy that Apple stock. Apple. An ETF performs the same way on a stock exchange, such as Apple, except you're not buying shares of a business. You're buying an overarching fund that holds multiple shares from multiple different businesses. These ETFs can track or follow multiple different securities or assets. Some of the most popular ETFs are SPY and VOO, which track the S&P 500, or just the general market. Something like the S&P 500 Core ETF may hold stocks in industries such as healthcare, science, or technology. This type of ETF is like an art museum that collects specific types of art, but from different artists. There are also industry-specific ETFs. You have SOXX, which tracks companies in the semiconductor industry, or ZEB, which tracks Canadian financial institutions. There are even ETFs for crypto. Whatever category or collection is on the market, there is probably an ETF out there for it.
Using ETFs is a fantastic way to diversify your portfolio and limit your risk in the stock market. Now, imagine a scenario where your portfolio only contains a singular stock. Price movements of that company will have a great impact on your overall portfolio. However, if you decided to put your money into an ETF containing hundreds of stocks, the truth is you wouldn't really care if a couple of them completely tanked. This is because the more stocks you choose to invest into, the less each of them will have an impact on your total portfolio. Additionally, many ETFs allow this diversification with very minimal initial capital. Say you wanted to buy stocks in Apple, Microsoft, Google, or even Amazon. Buying these shares without an ETF will cost you hundreds, if not thousands of dollars to even get started. Luckily, there are many ways to own these companies with an ETF without spending the crazy amount you would to buy singular shares. A great example of this is an ETF called QQQ, a general market fund that has a lot of these highly desired companies. It's also important to note that the holdings of ETFs are made available with just a little bit of research. Take a look at the contents of QQQ. I'm sure you'll recognize quite a lot of them. Let's say that you are confident that the healthcare industry is going to see a boom into the foreseeable future. Even for some of the most experienced investors, picking out that one company that'll perform the best in the entire industry is a very difficult task. This is why many investors choose to just buy the entire basket and not spend all their time searching for that one golden stock. As a result of the cheaper cost, ETFs allow investors to employ dollar cost averaging. And all this means is that they buy the same amount of an asset on a regular basis, regardless of any price changes. This helps by spreading out where and when you spend your money, making it easier to take advantage of short-term price movements. Without the use of an ETF, dollar cost averaging would still be possible, although the amount you need to spend would be much greater. Lastly, certain ETFs can be used as a hedge against the market. This means that when the overall market drops, these specific ETFs will do the exact opposite. This becomes useful when attempting to protect yourself from all scenarios. Investors who plan to keep their positions for a considerable amount of time might want to take advantage of short-term changes in the stock market. By allocating a small percentage of your portfolio into an ETF that contradicts the market, you wouldn't lose as much money if all of your other stocks went in decline. We hope that this video taught you something that you hadn't already known. And if possible, please feel free to check out our Discord server and even write us a comment down below. See you guys in the next video.